Hey, thanks for everybody being here on this Saturday morning. So again, I like the Saturday kind of interactive live events here. So markets are closed, we can kind of kick back, don't have to stare at the screen worried about positions, and we're going to dive into some really good strategies for, especially in this market. So selling options for income profits and hedging. So we're in a market of great uncertainty now, so it's a good time to be thinking about hedging and other ways to, manage your risk. So a little background on myself, started trading in my trading journey back in the 80s for a company called Coastal Corporation. At that time, they actually had a training program that would train you to, teach you how to trade crude oil and products and things like that. So I was very fortunate to get into that program. Spent a couple months down. They sent me down to one of the big refineries they had in Corpus Christi. Spent about 3 or 4 months down there, just kind of learning the whole process of oil, bringing oil in, put it through the refinery, making different products, and then ended up in the tanker group, chartering ships and just operational side of things, and spent some time there, which was a lot of fun. Being into the tanker side of things was pretty amazing. All the VLCCs and all the big tankers and stuff that we would charter. And then finally got on the trade desk. Spent about 5 years there with Coastal. Sent me out to Singapore for a couple of years, trading products and crude out there. That was amazing experience. Beautiful place. Love the people and everything in Singapore. If you ever get a chance to check it out. And then went to work. Got a great opportunity at a company called Transworld Oil. And they were at the time the largest oil trading company in the world. It was Transworld, Fibro, and Mark Rich. So spent 17 years with Transworld, and about 16 years of that in Bermuda, which was the kind of corporate headquarters. And then ended up running the international trading desk out of Bermuda for 10 years. So this is where I really started, sinking my teeth into options back in, I remember 1987, we sold our first option contract. We were selling premium on cargoes of Brent crude oil, receiving money. That premium was like, we thought it was like printing money. It was so fantastic. And, eventually that kind of led me into all the other different areas of option trading. So I've never looked back. So again, thank you for being here, and let us get started. So the following presentation this morning is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. Now, when you look at trading is a business of probabilities. And to be a successful trader or investor, controlling the risk is really what's going to win the game and help you succeed down in the long run. So by knowing and better understanding how to manage and control your risk, it's going to make a dramatic and positive difference in your trading or your investing performance. The best way to achieve this goal is through the use of options and option spreads. Now, this is because the unique option pricing structure that you get from options and option spreads, it offers you more controlled risk. So you can control your probabilities, and the probabilities that can be then tilted way in your favor. So when used correctly, option spreads are going to give you more defined trading risk for all your trades, lower your capital at risk, provide you greater trading leverage, and they're kind of an unmatched hedging advantage for your trading overall. Now, step one is to then know how option pricing works. So we're going to, kind of step into that so you can see how you can maximize your, profits from trading options based on the option pricing, how it works. So the first thing we look at when we look at options is the importance of understanding the concept of time and volatility and the impact that these two components have on the price of your option. So, the time price component is basically time value or extrinsic value of your option. So it's the premium that a rational investor is going to be willing to pay over its current exercise value, the intrinsic, based on the potential to increase in value before expiring. So this change in the value of your option based on time decay is measured by the Greek we call theta. Now, time decay always works against the buyers and it's going to benefit the sellers. So the reason is because option theta is going to either have a positive or negative kind of value or characteristic to it. So, if you're long a stock option, so let's say you're long a call or you're long a put, it's going to have a negative theta value. So it's going to basically, lose value as expiration draws near. So if your position turns sideways, you're losing value each and every day from that negative theta decay. Now, the flip side of that is if you're short a call or short a put, that's going to give you positive theta value, and that position is going to actually gain value, as expiration draws near. So these are the two things that are really important to understand. So, buying is, everybody understands, okay, let's buy low, exactly, but when you're buying options, you got to really be aware of that theta decay. So that's what we're going to talk more about on the sell side today to take advantage of that positive theta. Now, the other component is a volatility component, implied volatility. So this is expressed as a percentage of your stock price. So it's basically indicating a 1 standard deviation move over the duration of your option cycle or series. So that's basically what we're going to use the implied volatility for in order to see what is a standard kind of normalized move. So in theory, a stock should end up within 1 standard deviation of its original price about 68.2% of the time during its option cycle or lifetime. Now, this theoretical probability or forecast of a security's price range should always be a part of the process you're using for selecting the highest probability price targets for your trades taken. So when we look at it and combine it all together, this is going to what provides us the price of the option or the premium. So if we look at time value, that time component times the implied volatility times the underlying value, the intrinsic value, that's going to give us the option premium. So once we know these variables, then we're going to be ready to price out that option, know what the option premium is, and then go on down the road and select the right option strategy. So this table kind of illustrates kind of how this flows through for price. So basically, every Thursday we have on weekly options, most all the big large stocks are going to have weeklies, and the ETFs have these weeklies that are even daily expirations. But normal stock, every Thursday we'll have a new weekly option. And on that first day, there's 100% time in that option, okay? So then if you look at the time, that time component times the implied volatility, I plugged in a number of 300, left this intrinsic, the value of the security constant at 1, you can see then your option premium is $300. Now you come back in on Monday after the weekend, you're still getting that time decay. So at the end of the day on Monday, you come in and boom, your 50% of that time value component of the option is gone. So that's what's really striking against you. That's that negative theta value if you're long an option. So then you can see that even if you spiked up the implied volatility in this example to 800, it barely pushed your premium up. So you only went up to like 400. So this is a really big thing and factor to factor into all of your option trading is be aware of that time value component and also the implied volatility. And at the end of the day, at the end of those option cycles, they both go to 0. All right, so you're going to have no time left. Implied volatility goes to 0. So that's what we're going to take advantage of when we're selling options or any type of option spread with a sell side component. We're going to be able to take advantage of we're selling time and we're selling that volatility component, which both go to 0. So this can give us a really big benefit or effect or edge to our trading. Now then step 2 is then what is the secret of income using options? Well, it's knowing how to sell time. So we can, actually sell time by selling time to take advantage of option time decay or theta. Now you can look at an option, it's kind of like a coupon that you get at a store, so you go to the grocery store and you get these coupons, and you look at it, it has to be used by, maybe a week or 2 weeks. Otherwise, it's no longer valid. You can't use it any longer. Well, that's exactly like an option series. So, you look at the theta value and it's going to, at some point, that option series is going to go to 0. So it's like a coupon. It's going to be not indefinitely valid, so you have to use it. So when we look at theta, it does not remain stagnant as well. So your theta values, they're going to increase. You get more, start to really accumulate and increase as expiration draws near, and they decrease though as your options go more in the money or more out of the money. So they lose extrinsic value. So, as they go more in the money, they're getting closer to, more like, the actual security itself. And as they go further out of the money, that extrinsic value gets less and less too. Now, so when we look at an option, it really starts to take off and soar the last 30 days. And that's what we're going to take advantage of with these weeklies. You know, we've got these different weekly option series that we can really take great advantage and give us some really good different structures we can do. So here's just a kind of time graph to illustrate this. So if you were to go out 120 to 90 days out, the theta decay is very little. It's pretty flat. You know, it's going to be very, very small. So one thing is, if you're a buyer of options, that, you know, time is a gift to you. So the further out, the less theta decay. Now, once you start getting in at the end of the day, you start seeing this starting to tail off. And when you get the 30 days off or out to your expiration or day zero, that's when it really accelerates. So then we've got these weeklies that we can take advantage of to really play that accelerated theta decay and cheap options for different strategies to use. So to be aware of that and know how to incorporate in your trading is what we're going to talk about next. Now, step 3 then is trading the probabilities. So this is what I call the market maker secret. It's what they don't want you to know. So this is really important to understand the probabilities of your trading, which we can derive, you know, from options in our option, platform that we're using, the Black-Scholes model. Now, when you look at broad markets, you're kind of probably observe and notice they tend to have 1 to 3 week kind of cycles. So they'll trade sideways in channels in 70 to 80% of the time. So in other words, you know, your price is not going to go straight up or straight down. They'll cycle up, cycle down, and they'll have, you know, 1 to 2 or 3 week type cycles that you can play. Now, the sideways price action, though, is where you really get, you know, that time decay or theta really starts kicking in. So based on this sideways price movement, all out of money option buyers are going to lose approximately 70% of the time. So the market makers, they know this, or the professional money, they know these statistics, and therefore they're going to tend to trade from the sell side as much as possible, you know, based on these probabilities. So this is the professional money. So you really need to start thinking like these professional traders, like the money market makers, and it all comes down to the math. So let's check that out. Now, when we look at the option markets, the markets use mathematical market probability statistics for price and movement of an option to its expiration. So the basic option model is called the Black-Scholes model, which inputs, you know, time to expiration, volatility, the price of the option, et cetera, and that's going to, you know, give us our premium or the option price. And then we can take from that, we can take probabilities and use that to analyze our risk reward. So by knowing the probability of your underlying security or stock finishing within a certain price range at expiration becomes key to determining then what options you want to buy or sell, and then what option strategy to use. So these statistics then forecast then how likely it is that an option will fall within a certain option series price range, either up or down by its expiration. And this forecast is what we refer to, or we call the implied move or the expected move of the stock. And so basically the way I look at it, the implied move is basically estimating or an estimation of a, you know, plus or minus 1 standard deviation move of your underlying stock or security by its expiration. So when you look at a standard deviation 1, standard deviation with these series or options, you kind of think of that as a normal move, what it could do up or down. That's kind of a normalized move and way to measure that move. So if we look at this, this graph here, this is the normal distribution curve. So a bell curve, you know, statistics for showing data. So if you look at this, you'll see that the 1 standard issue, if you start with 1 standard deviation out, you're basically starting out with an 84% theoretical chance of a winning trade. So looking at this graph here, you can see this is the top of the curve of your distribution curve, and the price is trading at $500 at the money. Now, if you're looking at 1 standard deviation in this example, this 1 standard deviation price point, this would be for a 20% move up or down. So that 1 standard deviation price point to the outside is 520, and on the downside, then it's 480. So this is your kind of 1 standard deviation move from 480 to 520. That's that normalized kind of move. So the normal move could be, all right, it could go to 520 or it could go down to 480. So that's very normal, not exceeding or not stretching what you think you can do. And at that point, these price points, those are you can kind of associate that with what we call deltas. So with this 520, that would be like a plus 16 delta. Okay. And then on the sell side, on the 480, that's like a minus 16 delta. So the way then we can use this to kind of analyze and use it for probability analysis is to take the, delta, which a delta of 1 is equivalent to like 100 shares. Okay, so if you look at a delta, which is like the most of the delta would be 100, and if you had a 16 delta right here, you sold that 16 delta, then that's going to be the reciprocal of that is going to be your probability of the staying below that price, that 520. So anyway, so these are what we call kind of probability trade setups. So if you were to sell this 520 strike right here short, the probability analysis would tell you that theoretically there's an 84% probability that price will be below 520 at expiration. Or if you were to sell the 480 put, there's a 84% probability that price will be above. So that's a really great way to quickly analyze and use probability analysis for your trading. And so these really kind of point that out. Now it's theoretical, but it really does help when you do use this kind of analysis. So then you could say, well, if you look at like a delta of 5, that would be like here, that's like 3 standard deviations out, so you can see it really gets extreme. So a normal move is right here, but when you start getting past that 520, that starts to get stretched and extreme, and that's less normal. And the other way I look at it is if you look at a 16 delta, you can also think of that as having, okay, a 16% chance to get to 520. So it's really great quickly analyze probabilities of trades to know, what to buy or what not to buy based on probabilities of it reaching those points. So if we then look at the delta and the probability analysis on our platform, this is Thinkorswim, we can quickly see and measure these probabilities. So here's like Apple trading at $190. And so this is, to expiration 28 days out. And so here's your delta, and this is what we call probability out of the money. So if you looked at the, at the money price here of Apple, it's trading at 190. You can see the delta says 52. So that's basically 50-50. So there's a 50% probability that price will be at 190 or below, or 50% probability that it'll be at 190 or above. Now, when you start going further out in time or further out on price, like this 215 strike, you can see it has a delta of 5, okay? So that's 5. So one way to look at that is, okay, there's only a 5% probability that price will be at 215 at expiration, or the other side of that is probability out of the money says 95. So that delta of 100 plus the delta of 5 that price represents gives you a 95% probability that price will be theoretically below 215. So you can then see, if you look at then the price of that option, it shows you that option price is, going for $26 to $32. All right, so let's say $30. So, those are cheap, but it's a reason they're cheap because there's a high or low probability that the price will get to 215. Therefore, those are going to be cheap. But if it does, you're going to get rewarded because you're taking a lot of risk. So those are really important that you can do that quick probability analysis, using this kind of data. So by using this analysis, it's going to provide you a very useful tool for, determining your price targets to trade against. And it's also very, very useful for then helping you to set up hedges. So based on this math of probabilities, you're going to see that approximately 70% of your options bought are going to expire worthless. So based on this, it's really a good idea that all traders or investors to consider selling options just as much as buying. Or, the other thing that I like to do is put or combine the two together. So by option selling strategies or adding these to your portfolio, it's going to really help make a dramatic and positive difference in your trading performance over time when used correctly. Now, what you really need to know, and here's a good example of kind of to take this to the next step on this probability analysis. So in this example, think about you're bullish on Tesla, okay? And Tesla's trading at $198. So as a beginning option trader, you might be tempted to buy calls 21 days from expiration with a strike price of 285 in this example. because the cost, when you look at the cost on your option chain, they're going at 16 cents, which would be $16 per option contract. So when you look at that, you think, wow, man, that is amazing. I could do that and I could buy a lot of those contracts. So let's go through the math. So here's just a kind of chart to get a kind of idea of what you're thinking about or looking at. So here's Tesla, trading down here at this kind of 197, 198. And you're looking at, maybe buying way out of the money options, these $285 strike right here. When you look at that, they're like super, super cheap. Or you might look at them by the 238. So we're going to go through an example here to show you the costs and the probabilities of those and what happens in this kind of scenario. So let's say you purchase 100 shares of Tesla at $198. So that's going to be, equivalent to you putting out about $19,800. So then you think, you scratch your head and you say, wow, with that same $19,800, I could actually buy 1,237 contracts of those 285 calls, and I would be then controlling 123,700 shares. So, you're just like, wow, that is amazing. So then you're thinking, well, what if, Tesla, it hits 285 within that next 21 days, those $285 calls that I bought at 16 bucks, those are then, say trading at $1.16 or 116. Well, I just, pocketed $100 per option contract on those, contracts that I own, the 1,237 contracts. So that'd be over $123,000 in less than a month. So, you look at this at first glance, this kind of leverage really is awesome. But, don't let this kind of glitter fool you, because not losing money is just as important as making it. And so if you're going to be consistent in your trading or investing, especially trading options, you need to really be looking at your probability analysis to see if that's a good trade or not. So let's go through and analyze it a little bit deeper. Now, the one problem with short-term out-of-the-money options is that you're not only going to have to be right about the direction the stock moves, but you also have to be right about your timing. So this really ratchets up the degree of the difficulty of the trade. So to make the profit on that stock, it just doesn't need to go past that strike price, but it has to do it within a certain defined period of time. So in the case of these 285 calls, you need this Tesla stock to reach that 285 within 21 days to make your profit. Now, it's this dual objective of having it be not only right on direction plus timing that really lessens the probability of an option trade being a winning trade when you're just buying options. So, the way my trading plan set up, I look to base all my trades based on, high winning probability setups with tight risk management. So let's dive in a little bit deeper on this one. So in the Tesla example, you're wanting Tesla to move more than 40% in 21 days. So this, would be based on a measurements using standard deviation would be like 3 standard deviations. So not very many stocks are likely to do that, low probability. So in all probability, the stock would not reach that strike price and the options would expire completely worthless. So based on your probability using standard deviation, in this example, there's less than a 2% chance that Tesla would actually reach 285 by its expiration. So in order to make money on this out of the money option, you need to be very precise on your market direction, or you need to be very, very lucky to have this be a winning trade. So here's basically what it would look like. If you looked at the normal distribution curve, you're looking at out here. So a 3% chance, only a 3% chance statistically that the price of Tesla would get there. So then start thinking about it. So you're buying those and you've only got a 3%, but what if you sold? So that's going to go to your favor, right? So instead of a 3% probability, of getting there, if you're a seller, you're going to have a 97 theoretical probability of the price getting there. Okay, so that's the huge difference. So here it is on your platform. You can see here's your Tesla trading at 197.78, 21 days expiration. Here's your at the money 50-50 delta, but look at that 285 strike down here. The delta of that is 2. So there's a 98% probability that price will be below that at expiration. You've only got a 2% chance theoretically to get there. And that's why these options are cheap. 16 at 19 cents, that's like 16 bucks. So there's a reason for that, okay? Because it's a very high risk trade if you look at it from the probability standpoint. So then you think, well, what if Tesla got to 238, over the 21 days? Well, you're right about direction, but since you're wrong about how far it would go within that specific time, you still lose. And, losing on your trades is always a painful thing. So here's, where you'd be if you were the buyer of those options. You're going to be out of pocket $19,792, for those 285 calls if it's just trading at 238 at expiration. So you went out, you bought those 1,230 options at the 285 strike at 16 bucks. You put out a lot of money and you're going to be out of pocket basically that much. Now, if you look at the flip side, the option seller, that professional money is like, liking it all day long. So based on this probability, the better goal for traders a lot of times would be to look and select trades based on what's going to give you the most consistent return over time, not that one big time winner. And this is what's going to help you, make winning high probability trades better and more reliable if you look at the data and the facts. So where there's that big disadvantages of the one you saw from the option buying scenario from Tesla, you can look at the flip side and you're going to see the equal opposite opportunity for you. So if you're the seller of those options, that professional money or just knowing what you're doing, you can see that if you had sold those options on that example and you sold the 285 calls and you brought in $16 per contract, that started you out in that trade with a 98% probability statistically that would be a winning trade. The price would be below 285 at expiration theoretically, but these are high probability trades to start out with. So you can see that your $16 times that 1237 contract, now you're up 19,782 with a 98% probability of winning. So this is why the professional money takes advantage of selling options for not only generating profits, but also for hedging. So here it is for you, the seller, you get that opposite, bang for your buck. Here you sold those options, the 285 options, and you brought in that 16 bucks. So you just kept the other side of that trade, $19,792. So this really illustrates the importance and the dynamics of buying versus selling. And I really want to kind of point that out for everybody. Now, the next thing is knowing when it's time to sell. So here's, two different timing tools that I use that really help you to know when, number one, it's time not to buy, but it's maybe time to start selling or hedging. So we're going to cover this next. But before I get into that, I'm going to be doing a course, really in-depth course starting next Saturday, the 20th of April, that we'll start this course up at 11 a.m. Eastern, and it'll go till 2. It'll be a 4+ hour course, and then we'll finish up Monday the 22nd from 4 to 5 p.m. So I know a lot of you guys and gals are probably going to take off early. So what I want to do here is give you this, if you want to take advantage of this today, I'm giving a 15% discount off the price of my normal price of this course. So use this link here. Hold on one second. Let me get the link for you. You'll go right up here. It says powercycletrading.com/special. Copy and paste that in. Let me get that for you so you can just click on it or copy and paste it into your browser. One second here. Okay, so use this link here, and if you click on it, it's going to pull up this payment page. All right, so then you can see how this works. And giving you, you've got a number of hours today. Here's a countdown clock, actually about 7 hours. But if you'd like to take advantage of it, what you need to do is go in here, and you're going to use this promo code. It says sell, small cap 15. You're going to get an extra 15% off of the 2 different packages that I'm going to, offer you here today. So course package 1, basically, you can see the price of the course is, the normal price will be $197, for this 4+ hour workshop, which will start next Saturday. But additionally, what I'm giving you is I'm going to give you as a bonus, I'm going to give you my cycle reversal indicator, extreme range band indicator. These are what we're going to use to tell us when it's time to buy or sell based on these two indicators. So these will be bonuses to you. And those are $197 on my website. So those are going to be a bonus. Plus, I really use Fibonacci, what I call target mapping, to set up the price targets. So a very, very important part of how I trade. So you're going to also get that. That's a really great course on Fibonacci. That not only Fibonacci, but other things that I've put into standard deviation, et cetera, for targeting profits, take or defense targets. And then you're going to get 30-day trial membership to my trading club. We'll do a Q&A follow-up and another option trading tutorial. So, the total bonus value is over $1,200. So the value of this package is $2,600. And if you use that promo code here today, you're going to get, this 15% off. So about a 96% discount on that. And then course package 2 is if you want my alert service, which we'll talk about a little bit more. So the alert service package, and this one is what I call the Elite Open and Close Alert Service package. You're going to get everything in course package 1, but you're going to get my 5 trading alerts that I send out for the next 4 months, plus the trading club for 4 months. So these are the 2 packages. This will be $597, but today, if you use that promo code SELL15, you'll get a 15% discount. So you just go here, click on that, and then down here where it says promo code, make sure you use small cap SELL15. Click that in, and you're going to get that discount off $167. And then you do the same for if you want to do package 2 with the alert service. And we'll talk more about this a little bit later. So you can go down here, click course package 2. Regular price would be $597, but today, for right now, you can get a 15% off by just putting in that promo code SELL15. Okay, put that in right there. Click that, and you'll get that taken off. All right, so just want to put that out there in case anybody had to leave early. And here's the promo code. One more time, here's your link to use, powercycletrading.com/special. And then use this promo code small cap SELL15. All right, so that's want to put that out there, and we'll come back to this later. And you guys, questions if you have anything to ask about this. So this course is, all new as far as the course and all the stuff you were getting. So I don't know what I did back in 2021, so not sure at all. But these are all, when I do a course, a lot of the strategies are the same, but they vary and they differ based on the market environment you're trading. So this is a totally new course that we'll be doing next weekend. All right, so you'll get this today if you do the promo code for $167. If you want the alert service, it'll be $507, and there is a 2-pay. And you can start your either one of these, whenever you want. You don't have to start it right away. And with the alert service, you can start and stop. So if you go on vacation or take off, you can have that flexibility. Now the next thing we're going to look at, when is it time to sell or when it's time to buy? So I've developed a couple really great indicators, and these are what you're going to get as a bonus for the course. But here's a current update here on the S&P 500. So this is a weekly chart, and this is a weekly, what we call a weekly cycle reversal. All right, so this is based on this indicator, which shows you extreme ranges. So this is like a 20-period moving average, and then this is a normalized move. This white line, when we get to the blue line, that's getting very extreme or very stretched to the upside. And then the market is also very overbought based on my lower study indicator. So you can see that when this indicator crosses over, like where that arrow is, boom, you get that magenta arrow, and that is an indication or signal to give us alert to the probability of this market starting to roll over. So you can see it's been overbought for a considerable period of time. So typically, also, what I'll do when we get a really strong market, I'll wait for at least 2 of these arrows, and a lot of times we might get 3. But when we get the third one, that's a high probability that the market's going to stall. So you can see here what happens. You get exhaustion. Buyers are exhausted, and it's like musical chairs, and everybody, potentially starts selling when there's some kind of news, which happened Friday. So you can see another one back here, came up here, stalled out, reversal there, goes down. Now here's a reversal to the upside, okay? And then we had a beautiful trend. So these are two indicators that I put together, really helps you kind of navigate in and out. So that's, S&P 500 on the weekly. Here's another example. Here's a risk current QQQ on the weekly. You can see it too has the cycle reversal weekly, which I call long term. You can see here crossing over and see what it did, just went sideways, and now it's starting to kind of crumble a little bit more. So we'll see what the extent of this pullback is. And then you can see a reversal to the upside was right there. Okay, so it's a really great tool to use for anything. Here's just one more example. Here's Apple, with the weekly. You can see the cycle reversals here with Apple, weekly cycle reversal to the downside right there. Currently, we've got a weekly cycle reversal to the upside on Apple, which I'll show you in a minute. But just a really great tool for timing your cycles in and out of a trade. So what I thought we could do now is just kind of take a look to see where we currently are on a couple of things, give you a little bit of update on the market. So first off, let's take a look here at the S&P 500 SPX, and I'll show you this with all my tools, but this will highlight it. Let me see if I can get the right chart. Well, this is the one I was showing you currently. Here's the QQQ. And let me just show you some quick ones. I don't want to take too much time here because we've got a lot more to cover, but here's the S&P 500. You can see here with my extreme range bands. You can see here on the weekly, it's way stretched to that through what we call that's an average true range 3 to ATR. And now we've got negative momentum. You can see that red arrow. So we pull back here to the 8 exponential moving average right there. And let me check something else out here. Looking for my other chart to show you. Here it is. Okay. So that's the two indicators you're going to get are in there, but then I have my momentum indicators, which just shows you even more of what's happening. So here's on the daily. Now we're down currently. This is a key moving average, the 50 simple moving average. So we had a pretty good little move here, over the last week. And so, right now the markets came off really hard Friday based on, going into the weekend. There was a threat put out that maybe Iran might do something over the weekend, and that really got the market going down. So I think that, right here, this is key support. And you see this is what we call price action support through here as well. See all that price action going through there? So this is a really big support area. So 5,100, so this would be like 510 on the SPY. So if nothing happens over the weekend, I'm expecting a bounce back up, Monday, Tuesday. So that's what we'll be looking for. Now, if something does happen, then this 50 simple moving, if it gets taken out, then there's a lot more downside. But what typically, you'll see in these markets, again, they go in cycles. So this market on Friday hit this low based on a lot of, money risk off, things like that. And so if we do get nothing happening over the weekend, things kind of subside with that geopolitical tension, we'll probably get a bounce back. And then what we want to do is we want to watch closely to see how over this next week, we want to watch closely to see what happens on the bounce back. And what I typically will look for is what we call retracements. Okay, so I'll look at a retracement potential failure, or maybe it needs to get back above this 21 period moving average. So if we do get a bounce back, what I'll be looking for is to see, can it regain this 21, which comes in about 51.77. If it does, a lot of times what happens, it could have a move back up here, then fail, and then the next leg lower, and then we'll start using our Fibonacci levels to pinpoint, where it could go next. So 1 second here, I'll just put in real quick some fib levels so you can kind of see. So I'm just going to put in from this swing low back here in January to here, just a quick, let's just do it now. Let's do it with the SPY so you can kind of relate to that. A lot of you probably look at SPY a lot of times, and we use the SPY ETF quite a bit. So you can see here, I've already got this line drawn in. So here it is from that swing low back in January. So if we do break this 50 here, the next target down is to the 382. That's going to be down about 501 right there. So, you know, we'll see. So that's a key thing to be watching for as we go into Monday, Tuesday. So if nothing really pans out, hopefully keep our fingers crossed, nothing escalates more geopolitically, then I think the markets will stabilize a little bit and we'll get a bounce back. Here's a question. When you sell options, who has the other side of the trade? Good. So when you sell options, the buyer of the other side of the trade. So if we look at just, for example, we're going to go through a bunch of examples here. So that's a good question though. But if you look at just the option chain, let's say, for example, let's just say, for example, here on SPY, since we have that up, if you come in here and let's say you want to buy or sell, okay? So let's say you wanted to buy SPY and you wanted to buy the 510 strike where it's trading. So here's the bid. Let me get my pointer out for you. All right, so let's say you just want to buy the 510 strike, okay? So here's your bid offer. So what that is telling you is that you could buy if you wanted to bid the buyers are at 538 or $538. So their buyers willing to pay $538 or $5.38 per option contract. The seller though is at 540, so 2 cents above or $2. So there's just you can see all the option activity here. There were 31,000 contracts traded. So there's a slew of different people doing different things. There might be buyers coming in just to speculate it's going to go up. There might be buyers coming in to hedge. There might be sellers coming in to hedge. So you really don't know, but there will be a seller. So it's that kind of equal, there's a zero-sum game. So there'll be sellers going to buyers, buyers going to sellers, right? So that's really what happens. So no, it's no different from the future market. Exactly the same. It's all options are is just a derivative of the underlying security. So the options are, this would be an option derivative of SPY, whatever you're trading, it's just a derivative of that security. Okay, so the next thing is then selecting the right option strategy or income strategy. So we're talking about selling options, which can be used for a number of different things. We can get consistent income, we can get profit, we can get hedging, and we get a lot of things we can do. So one major goal, in my opinion, for every trader should be to select trades that are going to be based on what's going to give you the most consistent positive return, returns over time that are low defined risk and not always the greatest. So, the longer you start in the trading game, you're going to want to start getting things, a smoother equity curve, right? A lot of times when you're first starting out, you're young and eager and aggressive, you might think you're bulletproof and you take these big swings, you're looking for big, huge moves up. So you might get the big spike up, but a lot of times you're going to get the big spike down. So as you get more mature in your trading, you're going to want more of a gentle, better equity curve going up, and then occasionally you might have a nice home run and you get that curve, you continue to get that curve going this way rather than zigzagging like that, right? That'll just give you ulcers and that'll give you, all kinds of sickness over the long haul. So you need to be more consistent. So that's where we can come in and kind of prescribe the best option strategies. So then the best way to know is by understanding what are the option income strategies out there and available to you. Then you want to know and understand, well, how do they work? And then you're going to look to select the one that's going to be best suited for your trading style, depending on, do you trade all day? Do you trade just come in and out? Are you passive, whatever? And the other big thing you need to be aware of and consider in your trading is the market environment you're trading. So those are some things that you need to always input into your trade selection. So let's take a look. So when we look at the top option selling strategies, we're gonna talk about it today. The basic main ones that I'll go to are what we call the vertical credit spreads. There's also then what we call the iron condor credit spread. And then there's a strategy, what we use a lot called the long condor, so not to be confused, and we'll go through the difference. And then another thing that I talk about is what I call opportunistic hedging, okay? So when we're looking at kind of the sell side component of options, these are kind of the 4 areas or buckets that we can really dip into, for our trading. So these are going to be things that we can just do purely selling, or we can combine selling with buying to create some very fantastic option structures and hedging strategies. So the first one, we're going to talk about is the vertical credit spread. So this is a basic kind of income strategy. All right, so when we look at the vertical spreads, there are 3 basic types of credit spreads. So there's what we call the bear call credit spread, there's what we call the bull put credit spread, and then the combination of the 2 together is what we call the long iron condor. So, when we look at a bear call credit spread, this is one that you're going to use if you think the market's going to go down. But you don't have to have it go down, since it's a credit spread, which is kind of that probability trade we briefly touched on. If it just goes sideways, you're going to make money off that theta decay. So over time, it can still make that profit even if it's not going, straight down. So if it's just churning, it can stay stagnant. You're making money from that premium being decayed. So basically what you're going to be doing is just the simplicity of it, selling one call out of the money, while at the same time buying another call with a higher strike in the same option series. Or you could sell it at the money, but typically we'll go a little out of the money. All right, so we're selling a call short, but we're not going to be naked call. We're going to buy a call above it, so we're not naked. All right, so I don't really, you can do naked calls and naked puts, but I don't teach those because I don't want you to lose money. So you can have a great winning streak selling naked calls or puts, but at some point you might blow your account up when something really goes against you. So I kind of steer away from those as far as selling or teach my clients and members. So I like to focus on spreads because they're capping your risk, but they're also a great way to leverage up your return on your investment. So here's just a typical risk profile of a bear call credit spread. So in this example, this profile is showing you're going to be short the 1020 strike right here. So you'd be short that call right there, 1020, okay? And this is going to be, we're going to put a delta to it so you can kind of look at your probability. So that's going to have, like in this example, like a 20 delta, okay? All right, so this is what we call a probability trade. So then you're going to be long those, so you're capping your risk. So you're going to be short the 1020. You could just go naked, but I like to kind of cap that risk. So we're going to buy that call down here at 1030. All right, to cap our risk in case this thing potentially goes up. So we're not going to just have an infinite loss. All right, so if you look at this, the spread width then is $10, right? 1020, 1030. So that would be like per option contract, that's $1,000. Now, the trade here, the premium that we receive from selling the credit is $200. So that is your premium, that's your profit, $200. So your risk, though, is the difference, would be $800. So this is what we call a negative risk ratio. You're basically risking $4 to make $1. So if you're just starting out trading options, you're going to think, well, why in the hell would I do that? I'm risking $800 to make $200. Well, again, it comes down to what we talked about a little earlier on that Tesla thing, probability analysis. So theoretically, going into this trade, if you sold that 1020 strike, that's giving you a 20 delta. So that's like theoretically, you're starting out the trade with an 80% probability, theoretically, that price will be below 1020 at expiration. Now, price could go up to 1020, it could go over 1020, but at expiration, the theoretical probability is that it's going to be below 80% of the time. So that's why you started out like that. Now, when you do this type trade combined with my indicators or some kind of tools that you use that can give you a higher probability of that, then you actually increase your probability more. So think about the indicator I showed you, the reversal indicator. So that's a highly accurate reversal indicator. It's probably 70% accurate, over time. So if you add that to it, you can see your probabilities go up even higher if you have the right tools to help you on direction. All right, so that's what a bear call credit spread looks like. And here's one that we just did. I just showed you that, but this is an alert service trade that I sent out this past week. And this was on S&P 500 SPX. So I sent it out exactly because of what I just showed you. We had a weekly cycle reversal here, and we had a negative momentum. Plus, I'll show you here in a minute, we had a number of other things that were telling me that this technically looks like it's going to come off. So what we did, we set up a bear call credit spread, and we set this up on the 10th. We set this up on April the 10th. All right, so what was that, Wednesday? And so when we did this trade, the short strike that we sold was the 52.65. That short strike at that point in time, that was a 17 delta, okay? So really, very high probability trade going into this trade starting out. So that would kind of give you that 83% probability just looking at that. But we're using my tools, okay? So this is a moving average cross that I like to look at. My momentum was negative. So everything was stacking up that directionally this looks like it's poised for a pullback. And so then the reason that I selected this was that, okay, this market's been a strong bull market, right? It's been going up. And so, did this because it's in a bull market, longer term. So I was thinking, okay, even if we sold it here and it just kind of maybe goes up and down, maybe it just churns, we'll still make money, because I'm not totally convinced yet that we're going to have a total crater to the market. So a lot of times when I'm, doing kind of a potential counter trend trade, short or long, I'll start out with a credit spread, and then if the markets start to go more aggressive, then you can use other types of strategies to get more leverage and get more potential profit. But this is a good probability trade to start out with. So doing this trade setup, then sold at 52.65 and bought the 52.70. So that's 65, 52.65. That was a 17 delta, so like 83% probability trade theoretically. And then we took half position off Friday. It's an alert to take, close out half of it if you had, multiple contracts. So, 30 bucks of credit, collapsed down to 30 bucks. It went out to 30, $40, in the close. So that was a profit of, $70 per spread. That's typically I'll look at, 80, 70, 80, depends on the market, percent of the credit received. So that's an 18% return over 2 days. Now, if we get this thing to expire worthless, this will be about a 25% return. But that's based on it's a probability trade. So again, looking at the market when I'm first starting out for short or long, a lot of times I'll look at these types of trades based on the probability. So it doesn't have to just go straight down. If it just churns and goes like this, we can make money, because the markets are kind of in this transition zone here where they're not quite sure what to do. The trend is getting a little bit long in the tooth, but the markets are still, there's still buyers coming in. Now, the next one is what we call the bull put credit spread. So this is going to be best used if you think the market's going to go up. But again, like the call credit spread, it doesn't have to go up. It can go sideways. So you're selling one put while at the same time buying another put lower to cap that downside risk if it goes down. And so here, again, we're going to have a negative risk ratio. So here's an example. This was like on Apple. And so this was selling the 149 put right here, short that put. So if you're selling puts, you're basically taking a kind of a long bias, and then to cap the risk, bought the put down here. That 144 spread width is $5. You see here, so this was the 149, 144, $5 between the spread, brought in a credit of $105. So the difference is what we call the margin. So you'd have to put up $395 to your broker in your account, $395. And then if you keep the full premium, your return on margin on this trade would be 26%. Again, it's a probability trade. This was like a 20 delta, negative 20 delta on the short put. So giving you 80% probability price would be above. So in this example, you're risking, $3.76 to make $1. So that's a negative risk ratio. Now here's an example of one we did on AMD, and these are again the indicator tools that you'll get in the course. So here's AMD, it came down to that 3 ATR, oversold, had a reversal here. So the first trade setup was doing a bull put credit spread. Then, we could do other trades as this started to develop into a bigger trend. So started this trade out, did a bull put credit spread, and sold the, here in this trade, sold the 77 put, bought the 72 put, brought in a $95 credit, okay? So $5 wide spread, 95 bucks. So closed it out. The spread was then closed out, $91 profit, 22% return. All right, so that's a bull put credit spread. Now the next one is the combination of two together. This is what we call the iron condor credit spread. So this is where we're combining the bull put credit spread with the bear call credit spread. So really great for legging in, legging out. So if you feel a stock is going to trade in a tight range between two strikes up or down, to kind of stagnate in a range, this is an ideal strategy. So it's great for premium collectors who seek to minimize potential loss in the event the stock moves adversely through your resistance or support. So again, this is going to take advantage of that time decay component and volatility crush, those two components going to zero at expiration. So here's kind of the basic profile, what it looks like. So let's say you sold a call here and you bought a call. So here's your bear call credit spread, and then you sell a bull put credit spread here. So when you do the two together, this creates what we call the iron condor. So for example, let's say let's say this is a $4 wide spread, and you were able to bring in $100 credit for that bear call credit spread. So then you can see your risk then would be $300, right? Okay. So if you kept $100 here, your risk is 300. That's a 33% return on that side. Now, if you add the other side, let's say you think this is going to be range bound. Okay, it goes up here, it goes down. Then you could do this range bound. Let's say you did another credit spread and you sold the bull put credit spread. So you can leg this in, or you can do it all at once. And let's say this one you brought in $100 on that leg as well. So your risk is, the same. So you've got $200 now. The spread risk is still the difference between the $4 wide less your 200. So your spread with your risk is actually just $200. So you can see the huge return. I'm sorry, your risk is 400. So you can see the return on this would be like 66%, double. All right, so that's the beauty of the iron condor. Plus, we can leg in, leg out. So the example I'll show you next is one that we did on Tesla. We legged into this trade. So this was legged into an iron condor credit spread on Tesla. It was kind of stuck in a range. And Tesla's a really good one for credit spreads. It kind of, a lot of times will get kind of range bound. You can see this range in here. See that? And then you can see this range. It had this range for a long time. See, this is what you want to look for. See this area here, it came down, it had a big support. Then it came up here, this is a Fibonacci level, like a 50% retracement. So it came down here, came up, look at that, failed, came down, came up, came down, came down, came down. See how it failed? And then it broke out, and now we're in a new range. So these are great once you establish a range. All right, so here's one we did on Tesla. So we started this out, legging it. The first leg was a short bull put credit spread. So Tesla had opened up down, and so when it was down, we were looking for a bullish trade. So it was down, it was traded at 243.30. So sold the short the 237.5, 235 bull put credit spread right here, brought in $60. Okay, that was like going for a 20 delta, so 80 probability trade there. So sold that, brought in $60. Okay, so if we just did this and kept the full amount, that would be a $46 or 24% return. But we were going to look to this to move up, and then if it moved up, we're going to look to credit spread on the call side. So leg two was, when it did move up, now it's trading at 253. So it went from 243 up to 253 the same day. And then we sold this out of the money bear call credit spread, the 267.5, 70. This had a 23 delta. So 77% probability. So sold that call credit spread there. This one then brought in 38 bucks, all right? This was way out of the money after it had shot up. So now we had on this trade a condor, iron condor. So you can see where we started was right here. Started the morning right there, was trading right there at 240-ish, and then it spiked up right here, and we sold this way out of the money call credit spread up here. See that? And then when it was down here early in the morning, we sold that. So we had these two short strikes. So this one we sold way out of the money. That's because we sold it on when it was moving up. That's kind of the way I like to do these a lot of times. So we brought in 243, and then it went up to 253, saw that. And so now we had a total credit from the two of them of $98 on our spread width of $2.50. So we had a risk of 252, potential credit of 98 if we kept it all. And so that's going to be a 64% return. So that's, what we did there, legging into that credit spread, the iron condor credit spread. So these are great for that kind of range bound type of trade setup. And here, when it opened up down, we sold that put spread here. And then when it rallied up, sold the call credit spread there, brought in a total of 98 bucks, and we ended up taking it off, making $91, 60% right there. So really, great strategy for that kind of environment. Now the next one is sometimes people get these confused, but this is a total different animal. So this is what we call the long condor. All right, so let me just kind of map out what this is. So the long condor, what we just covered was the iron condor. The iron condor is two credit spreads. Okay, so the maximum you get is just your credit received. But the beauty with the long condor is a debit spread with a credit spread. So you're going to leverage your return. You're going to get 2 to 3 times your return. Here, you've got a, maybe here you're getting like a 66% return. But if we do this condor like this, we can get 100, 200, 300% return. So we could do it with calls or puts. So let's say in this example, you'd be long call, short a call, and then short a call, credit spread, right? So you're long a debit spread, short a credit spread. So totally different, or we can do it with puts. So we do these a lot because they're just a really low risk, but give you a great return. Now here's one we did. This was an alert trade as well. All these trades I'm showing you are either alerts or trades that we set up in the room. So this is what we call a volatility squeeze. This is what I love this trade setup structure when we're in a squeeze. So when we're really consolidating, churning, and then we're looking for a big explosive move up or down, this is a great way to trade those types of moves on very low risk. So we had this, really tight wound up trade. Momentum was up. So we theoretically, based on indicators, we thought that it was going to break to the upside. So we did this with a long call condor. So it's traded at 116.30 and we got out as 118.70. So here's the trade setup. Okay, so we came out here and did this. You can leg these or just put it all at once. We put this on it all at once. So you can see this was like the long, the 116 call to 118. So there's your kind of a call debit spread. Then we had sold against it the 119, 121. So there's the bear call credit spread. So these spreads were $2 wide. And so we brought in the cost of the trade. It's a debit cost. So that's our maximum risk. So 67 bucks per spread. So the spread width was 200, our cost 67. So this had a potential to make $133 on that risk of 67, 198% return. All right, so we have that call debit spread, bear call credit spread that goes out in here. We make $133, 198% return. If we don't, if we're wrong, the max we could lose is 67 bucks. So it's got a positive risk ratio. And so this one worked out really well. So it went out exactly where we wanted it to, right there, right in the middle. So it went out from the spread. We had that set up. We had the trade originally, the $67 debit cost. Spread blew out to 178. So here's our exit, 178, cost 67, $111, profit, 166% return right there. So these are really great strategies, and we do, again, we do these quite a bit. All right, now the next one is the other kind of category is, our bucket is opportunistic hedging. So here's an example of one we did where we had a short on QQQ. We had started out with a put debit spread, and when it really cratered to the downside, we were able to hedge our risk and recover our full amount of the put debit cost by the credit received from the bull put credit spread, and made it into a no cost free trade. So this is great. And so I always tell our members, clients, always think 2 or 3 steps ahead. So when we planned this trade, we were looking for a potential for a big breakdown. So it's trading at 365. It was breaking these key fib levels here, negative momentum. So then what you're looking for is, where can it go? So we were looking for a potential move down here to this area here, this 355 area. So what we did, the first thing you'll do is you will take some profit, and then when it moves down more, we could sell it. If we could sell it out of the money bull put credit spread in this situation, recover our debit costs, then we're set up for, typically these things just don't keep going down. They'll bounce back up, and then we're into this long put condor in this example for 0 risk. So that's how we set this up. So first trade part was the put debit spread. So we entered that. It was traded at 365. So we went long the 364, 360 put debit spread. Total cost of the trade was $1.21. All right. So then we had then the potential on this trade was a $4 wide spread less our cost, 121. So really nice positive risk ratio. If we kept the whole thing, if it closed down, we make $279 or 230% return. Now, the other reason that I like to do these is a lot of times you'll see in these markets, the markets will go down. They'll look like they're going to keep going down, but then the next day they'll hit like a support like we did on Friday, and they'll bounce back up. So we'll adjust these to this kind of condor. So then if it does jump back up, we've got it adjusted to a free trade, and we can still stay in it. We don't really lose the opportunity. So then it cratered down, so we sold against it when it was trading down. Trade 2, it was trading at 354.53. We sold it out of the money bull put credit spread, 354, 350, received $141 credit, right? So that offsets that debit cost. Now we're into the trade actually with a credit of 20 bucks. So if the market just goes down or up, we're still going to make, in this example, $20. But if it goes out between our 2 spreads, the max profit here is 420 bucks. All right, so that's actually exactly what we made, because it went out right there at expiration, and we had 0 risk on the trade. So just a really fun way to trade if you understand the structure and then know when to do it. All right, so those are some ways to trade all the different variations of the market. So you can see here there was no cost to the trade, 20 bucks, potential profit 420, and so this was what I call opportunistic hedge trading management. So we can do these for down markets, up markets, it doesn't matter. So if you'd like to learn more how to master these selling option strategies for income, profits, and hedging, here's what's coming up. So again, next weekend, I'm going to be doing a course on this, and use this promo code SELL15, and then look to use, I'll show you the exact links and what you're going to get and take questions. And then if you want to see the offer real quick, and I'll go through the offer here in a minute as well, but use this payment course offer list link there. All right, so here's what you're going to get. So we'll start the course, will be next Saturday, the 20th of April. Everything will be live and recorded, so you'll get the recording. This is yours forever. And then we'll start at 11 a.m. Eastern and go to 2 p.m. Or I usually go over because I take questions as we go. So as long as it takes, so you'll get that. And there are six enrollment bonuses that you'll get. So the course price is $197, but if you use the sell one, that link, or you can just go to the special offer there and you'll see the link. You're going to get the course for 50% off. So the course price is $197. So the course value, $1,400 for, you know, my time putting the courses together, all that stuff. So 86% off there. And then I'm giving you all these bonuses, which I think you need to really be successful at these types of trades or any trades. You need to understand direction, and these are going to help you with your direction. So you're going to get my cycle reversal indicator, and you're going to get my extreme range band indicator. These are two great indicators on my website. They're 197, so you're going to get those for at no cost. Let me show you where they are on the website here, so you can check it out if you do want to. 1 second. So these are really great indicators that I use for every trade. So if you go to my website here, you're going to see, go to trading software. So here's all the software, my scanners. Here's my full custom, all my custom indicators, but here, multi-time frame, I've got a lot of stuff that I've put together here, but here are the two indicators you're going to get today with the, as a bonus. You're going to cycle reversal indicator here. It's available for Thinkorswim, TradeStation, TradingView, and well charts. We've got it coming up, not quite there. So you can see here more detail. This is $197, and then you're going to get my extreme range band indicator. This is also for Thinkorswim, TradeStation, Ninja Trader, and you know, you can have one or all the different platforms. There are no additional charges, and so you can see here this 197. So you can check it out there if you'd like, and then so you're going to get those two bonuses, and then you're going to also another big part of all my trades. It's going to be based, like I said earlier, based on Fibonacci price target mapping. So this on my website is $297. Then I'm going to give you a 30-day trial membership. You can start this whenever you want, and so it's $97 if you want to stay on after your 30-day trial. We've got other type of memberships as well, but that's the, you know, do month to month. And then we'll do a live follow-up Q&A, which will also be recorded. We'll probably do that the next day, and then I'm going to give you my option trading tutorial. So we'll go through. I'll show you what they look like. So, you know, everything combined, you've got a nice, you know, bonus package here, 2,600, 197. But if you use the promo code today, it's 167. Okay, so use that cell 15 and get that extra amount off today. Now, if you want my elite open to close alert service, this is course package 2, and so this has 5 different alerts that I will send out. Okay, so you'll get this for the next 4 months. And again, you can start and stop whenever you want. Plus, I'm giving my 4 months of my trading club, which we'll talk about as well. So you'll get the 4 months, the alerts, 4 months the club, plus everything in package 1. So everything you saw there, which was 197. So when you look at the alerts that I send out, I'll send out butterfly or long condor trade setups, calendar diagonal trade setups. And I'll go through and show you some more of these that I've done, that we've done recently. And here's another one. These are really cool. These are either penning trades that are maybe butterfly or calendars. Send those out. Breakout reversal trades. These are typically credit spreads. The SPX one was one that we did last week. And earnings trades, so selective earnings trades. So a lot of different trades that I send out depending on what the market is telling me. And so you'll get that. And so here again, just everything there. So here's just the link there. If you just want to just jump on it right now, you can use this powercycletrading.com/alert cell, and this will give you that payment link there, showing you everything you get there. So you can click on that link there if you wanted to, and it'll pull up that payment link here, and you'll see everything you'll get. And then again, if you want, it's got a 2-pay if you want. If you want to use that promo code, just slip it in there, cell 15. And there's 2-pay if you want, so you'll still get 15% off that. Okay, so use that. And also, if you do want my other indicators to go with it, you can get, there's an upsell here. These give you my dynamic trading model indicators, which are all the indicators, all my momentum indicators and everything that I could combine with everything I was showing you earlier. I'll show you those real quick. So the upsell 195 is, you'll get these additional indicators, my momentum indicators below, okay, and my volatility squeeze indicator. So that's a combination of that. So use that. Now, if you just if you want to just course package 1, that's powercycletrading.com, sell 1. I'll just put that in, then we'll move forward and you can ask more questions. So use that. All right, so click on that and then I'll pull up that payment link. Right there, and again, for today, use that promo code right there. All right, so that pretty much covers that. And then if you just want to, look at the whole thing together, see both offers, which is a real easy way, go back and use this link I showed you earlier. All right, so that's what you're going to get with the course package 2. You're going to get, all 5 alerts, 4 months, typically 8 to 12 stocks. We did 4 alerts last week. We did a Google, we did a butterfly, we did a IYR, we did a calendar, we did bear call credit spread, SPX. So we did 3 trades last week, and so you'll get all 5 of these different alerts that I sent out, butterfly or condor. So last week we did a butterfly on Google. We're still in that. Last week we did a calendar on IYR. I'll show you that. And then we did the SPX bear call credit spread. So we, have 5 different types that will be sent out. Now, when I send these out, there you get a specific trade alert guide. I'll send you exactly the option trade, how to do it. It's very, very well explained. Then at the end of the day, I'll do a video review of that, show you the setup, why I did it. Those are archived. Then we do a weekly Q&A every week, which is live and recorded. So you'll get that for the next 4 months. Then a video newsletter. At the end of the day, I do that to tell you what, my perspective on the market, things like that. But the big plus is you get my virtual trading room access. So every day during the week, 9:30 to 10:30, you can come into the virtual trading room, ask questions on your trades, see what we're doing. So you get that, for the next 4 months, and then 60% discounts on everything on my website, all other courses, all software. So a lot of really good perks if you'd like to take advantage of that. Again, with the 30-day trial membership, you get the trading club, so you get all this with that as well. All right, so here's what you'll get. And if you want to check things out more, here's my website. You'll see if you go here, you can also see the all the stuff that I have. Courses here, you can see all the trading courses, all the different option trading courses. So you get any of these for anything else here you'd like for 60% off. And then again, all my trading software was 60% off. You'll get a member's code. All right, so that kind of covers you on that. So remember to use cell 15. Now here's the alert service. Here's a summary just to kind of show you these are unaudited, but this is kind of summarizing how this has been performing. It's been really consistent. We've been holding about 79, 80% reliability on these trades. So started the first part of the service back in May 2018, and through yesterday, we've had 720 closed out, 521 winners, 45 break even, 154 losers, 79% win rate, unaudited. So really high probability trade setups, and then it could be one of 5 of the different alerts. All right, so here was a really nice note from Pam, said just sending a quick note of thanks to you could pass along to Larry for all the fabulous teaching through the years. I've truly enjoyed learning from him, the other traders trading the room every day. I think I don't think there's a better trader in the world when it comes to option spreads and the other ways to trade than Larry. And so here's what we're going to cover in the course, just kind of an outline of it here to next week. So we're going to start off with the live course on the Saturday. And so we're going to start with the option Greeks that are really critical or vital to understanding how to sell credit spreads, how to use option delta probabilities. We're going to go into that in more detail. I'll give you then my option selling guidelines and rules in the course. We'll go through that. And then, option pricing, the effects of time volatility on that. And then we'll go through, how to use what I call my price target mapping, standard deviation, analysis to set your targets for your directional moves up and targets for your defense targets. Then we'll cover what's the best market time frames for the credit spread. Should I go out 2 days, 2 weeks, 3 weeks? And then we'll go through, how to, implement and use these two indicators for telling us cycles, when it's time to sell, when it's time to buy or sell call spreads, put spreads, et cetera. These will really help you turn the cycles in the markets and, how to trade cycles. And then part two, we'll go into the 4 best option selling strategies, which to use, when, and how. So we're going to cover in depth with examples in great detail. We're going to go through step-by-step guide for setting up and selling a bear call credit spread, the bull put credit spread, or the iron condor. Okay, so then when to use the bear call versus the bull call versus an iron condor. So you're going to be totally clear on how to use those, when to use them, and the conditions to look for. So what market conditions are the best for your credit spreads, which one to trade. So we'll go through that so you can select the proper one. What's the best time frame for entering and exiting? And then here's a 5 best known rules for trading credit spreads. We'll go through 5 different defenses for defending a trade. So this is worth the course admission right here. So how you defend a credit spread. So there are 5 different defense strategies that I use that I'll teach you in the course for defending a credit spread. And then we'll go through when and how to use the long condor. So a super awesome strategy that we use a lot of these. So when to use the long condor, not to be confused again with the iron condor for your trend trades. So a low capital risk strategy that delivers returns of 200% or greater, gives you positive theta, no time decay. So we'll go through all that, big advantages that this has over the other spreads and why. And then you'll get a step-by-step kind of guide to putting these spreads on to construct the condor for your bigger profits, low risk. And then we'll go through, adjustments to these, if we wanted to maybe adjust to a broken wing long condor or ratio condor, so we can really create hedges off of these trades too. So we're going to go through that. And then part 3 is going to be hedging. So we're going to go through a complete kind of what I call a progression of hedging with options. So how, why, and when to use a credit spread to hedge a core trading position. How, why, and when to use the condor to hedge your positions. And then again, we're going to go through in this course, I'll teach you the 5 different ways to hedge credit spreads and still make money even when you're wrong. So we're going to go through the 5 different credit spread hedges. So big, really great part of the course there. If you do credit spreads, that's what you're going to really want to pay attention to. And then we'll, other tools and tricks, we're more about assignment risk, how not to be worried about that, or expiration risk, or auto exercise. So we'll go through that so everybody's comfortable with that. And then you'll get a trading library of, a lot of past trades that you can go through and look at examples. So really a great course. I think you're going to get a whole lot of great benefit out of it. And so here are the enrollment bonuses. Again, everybody will get my trading indicator, the cycle reversal indicator. Okay, so this is a 2-study indicator. It's got the upper study that shows you actually with arrows the reversal. The lower study shows you exactly when the crossovers happen. And so again, available for Thinkorswim, TradeStation, TradingView. All right, so you'll get that any of those platforms that'll work with, and so you have one or all. So you'll get that cycle reversal indicator. Then you'll get my other second bonus too, where we get my extreme range band indicator. So this shows you when markets are super extended or stretched to the upside or downside. And when we combine this with the overbought, oversold reversal indicator, it's a really great tool for picking, selling or buying the markets when they're overbought or oversold. And so again, you have a choice. You use Thinkorswim, TradeStation, eSignal, NinjaTrader, one or all of those. Okay, so you'll get that indicator. Here it is combined with everything. Here was like QQQ on a daily. You can see it way above that 3 ATR, and then had the reversal right there. Here's another reversal right here. So you'll get that. And then you're going to get my price target mapping course. This is using Fibonacci, and I use this as a combination of Fibonacci, moving averages, which I call automated trend lines, looking at price action support resistance levels to align, and standard deviation and unusual option activity. So this course shows you how to use all 5 of these as alignment to really establish really, powerful, big major areas of resistance or big areas of support to trade up or down against. But the foundation being the Fibonacci. And so this is a 3-hour course, 139-page course manual. So this is a free bonus, but very important. So all my trades are going to be based on using Fibonacci, and this is as far as the trade management. So that's why I wanted you to have this bonus. And then you get a 30-day trial membership to the trading club if you do the package 1, or if you do package 2, you'll get this for 4 months. So with this 30-day trial membership, you get the virtual trading room access, 9:30 to 10:30 Monday through Friday. I do a daily video market update every day during the after the close. We do a members video archive when we do our Q&As. So these are every week live and recorded, usually every Tuesday. And then there's some really good trader educational vault material in there, and then you'll get 60% discounts on all courses and software on my website as an additional benefit. And I always like to show this one. This is from Jay, one of my old members. Said, Larry just wanted to say, my option knowledge has leaped exponentially since joining your trading room. Says reading books is fine, but seeing the actual option trade setup makes a huge difference. So I always like to point that out. That's very, very true. Then you'll get my follow-up Q&A. We'll do that probably on Tuesday. This will be live and recorded. You'll get that, but remember, you'll also get the 30-day trial membership. So that's additional support. And then the last but not least, you're going to get another option trading tutorial. This 60-page option guide with videos on the Greek. So Delta, Gamma, Theta, Vega, market maker secret, more information on that. A really good tutorial for you there. So here are a couple of trade setups on the alert service I want to show you here. And then if there's any questions, feel free to call. So here's a really nice feedback from Dan. You're very diligent and totally thorough with your analysis. That's foundation of your success of your alerts. I paid for my subscription with the first 4 trades. So this is typical of a lot of members I took with you when I was learning how to trade options. Please feel free to share this with other participants if you wish. And then Scott says, it'll be the best investment that you ever make. Go with the elite package, great group of traders too. So again, when I send out a trade, a lot of members just do their own thing. They just want the trade setups, the entries. So I'll give you the entry level, but I will also always give you what the preferred option trade is I see on the trade. But when I send it out, you get the profit targets based on the unusual option activity, defense targets, what option series to use, stop loss levels, guidelines. These trades are listed and archived. Then I do a trade setup video review that night of that trade. Then we do a daily video newsletter I do every night after the trade. We do a weekly Q&A so with the trading room, you'll have this trading club, for the next 4 months. And so you can stop and start if you want, if you go on vacation, access the virtual trading room each day during the week, 9:30 to 10:30, and then discounts. Okay, so a lot of good stuff. So here's the kind of overall summary. And here are a few trades just recently done. So here's the butterfly long condor alert service part. So started this service back actually in May of 2019, and through yesterday we've had 162 trades closed, 114 winners, 11 break even, 37 losers, 77% win rate. Now these are very low risk trades, typically maybe $50 per spread on average, with potential to make 2 to 1, even up to 25 to 1. So we've had trades on Tesla and stuff where they've made about 2,500% return. I'll show you one of those here in a second that we did. All right, so here's one we did not just recently. This was on Microsoft. This was a broken wing long call condor, which you're going to learn how to do in the course. So these the instructions when I send it out, they're very, very specific. It says new Microsoft long, trade around 423.70, trade set to play a daily volatility squeeze breakout above its prior all-time high. So then I go through and tell you then what the trade to do. And so the first trade, we set this up as a call debit spread first, and it was around 30 bucks. And then we added to it the credit spread side to make it a condor. And then, I just, here's kind of more, I'm constantly sending out alerts to update you on what it's doing. So here was later on the 22nd, said trade around 428.55. We set this up when it's 423. At that point, I'm telling you, okay, max profit on close between there. I'm telling you, look to take profit. It was up $200 a spread or 400% return. And then I sent out another one later in the day. Here was trading at 428. Looks good for a close between 425.35, about $203 per spread. So, just constant update there. We use a service called Telegram. This is what it looks like. It's really fast service. These alerts go out as soon as I hit the keyboard. They're out within seconds. Here's kind of what it looked like. Here was one that we had on, Friday was IYR. I'll show you this one in a minute. So this is, updating you. It says trade around 85.09 if long, the 26th April, 85. This would put calendar. I said to take some profits, and then I told you how to adjust the balance. So I'm constantly updating you on how to do that. So you follow the instructions, you can pretty much do it without even knowing how to trade options. And a lot of people do it like that. So here's the trade setup. Here was the Microsoft broken wing butterfly. I got in right here. So using my indicators, and then we had this call condor that we set up. And so this was long the 422.5, 425 called debit spread. That was $2.50 wide, but then when it ripped up, we sold the 435, 400 bear call. That should be 440. Yeah, that should be 440 bear call credit spread at $5 wide spread. All right, so we had our max risk on the debit cost was 47 bucks. So then we had a potential profit of 250 less our cost of the trade of $203, 431% return. Now there's more risk on this trade, but I won't go into the details on it. But for this trade, the way we did it, there's basically no risk. But when you look at the profile, it shows you there is, because it's a broken wing. So here's where it went out. So we were long that call spread here, short of this when it ripped up. This is what we call a broken wing condor, 47 bucks spread entry out at 247, $200, 245% return there. And here's Abbott. Showed you this one earlier. This was a alert trade. I'll just kind of plug through there. Here was that breakout there on the volatility squeeze. Now this is a really cool trade. This is one we did recently. This was what we call a lotto trade. So this was on Tesla. This was a monthly pinning trade. So this one was just really amazing. So when we set this up on the 8th of February, it was traded at 189.35. And then on the 16th expiration, it went out right at our target of 200. So it was up $231 or 1,925% return in 8 days. So this shit tells you exactly what we're doing. Set this trade up for 12 bucks. And then here it tells you, how to get out, etc. So I won't spend too much more time on that, but you can look back here later if you'd like. And so we set this trade up right here. We were looking for this target right up here based on Fibonacci and option activity at the 200 strike. So we did this butterfly, 197.5, 200, 200, 202.5, $2.50 wide spread. Look at the cost of the trade, $12, 12 cents, 12 bucks. So spread width 250 less our cost. Potential $238 per spread, 1,983% return. And it made exactly that at expiration. So here it was going out on the 16th. It was up 231, right towards the end of the day. So it was up $1,925 per spread. And then it went out, it closed right at 200. So this is one of the few that I've ever seen just totally perfect pin. So that was amazing, 1,983% return based on just that exact close. And here are a couple that I'll show you on the counter diagonal. So we do a lot of these, just the structure is great. And started this back in 2019 as well through to yesterday. 275 trades closed out, 201 profit, 14 break even, 60 losers, 78% reliability, unaudited. And here's one that we just recently did. This is one we did on, get rid of this. This is one we did on IYR just, on Wednesday. So this was a long put calendar. Okay, it was traded at 86.33, and we did an adjustment in profit take Friday. It was traded at 85. So this is what we call a put calendar. So it says new IYR short, trading at 86.33. And I'll tell you why I'm doing the trade, kind of brief description: cycle high reversal or retracement failure off the 618 retracement or fib level. So it says buy one calendar. So you buy 1 or 10, you know, I just do it per, like the option platform says. So this was buying the 26 April, selling the 12 April 85 put set at 65 bucks. That's the max risk. And then on Friday, sent out the alert. Now it's trading at 85.09. Said if long that put calendar and long multiple contracts, you want to make sure take some profit, and then I tell you how to adjust. So we're going to adjust the trade. We're going to roll the spread, that short strike, the 12.85 put. We're going to roll that down. We're going to roll that to the 19 April 83.5. So then we ended up going long. Now we're long the 86, the 26 April 85 put, and now short the 19 April 83.5. So that's we adjusted that to a put calendar diagonal. But anyway, these are the kind of trades that we do. And so here's the trade setup. You can see it was based on my indicators, momentum down. We had another reversal indicator here, so looked really good. We're looking for this target right there. That's the 200-day moving average at 85. So that's why we set the calendar at 85. Now that's potentially breaking there. We adjusted this and widened out the spread to the 83.5. But here's how the first part of the trade went out. So we set this up. It was trading 86.33, and then we took profit and adjusted the balance. Friday it was trading 85.04, and so exited out at $1.11. Entry 65. So partial profit 46 bucks, 71% return. And so that was the trade there. And it's currently, let's see, I'll show you what that trade is doing right now. Let me pull up my platform here. So this trade now is up about 70, let's see, it's up almost 100%. Here's the adjustment to the trade, just to show you quick on this IYR. So now we've got this adjusted to, now we're long the 26 April 85 put, and we rolled the short strike down to the 83.5. And our adjusted cost is $49. That's our max risk. Went out up 44 on that risk of 49. So, you know, 90% return, but this has potential that if it goes out at 83.50 on this next Friday, this will be up over 130 on 49 of risk. So really cool low risk trade. And then one other one we did recently here was ExxonMobil. This one we really crushed it. This was a really great upside trade. Went long and did this with a calendar diagonal and kept making adjustments after adjustment and ended up with a big home run trade on this. So we got in right here. This was what we call the volatility squeeze. And then we made a number of adjustments and look, just trended that trade, just followed it to the upside. So here was the trade on the 12th. It was trading at we got into the trade when it was trading at 105.80. And then we did a profit taking adjustment when it was 108.65, and then we rolled the spread up. So now we started the spread out with the let me back up. I'll show you how we started the trade. We started really low risk. So we started the trade with a 106.108, which is $2 wide spread. And then when it moved up, we adjusted the trade now to the 106.110, widen the spread out and roll the short strike out. And so we had a profit the first go around and then adjustment. So we had on at this point in time, we had a profit take. We're up about $185 on that initial spread. And then we adjusted it to the 106.110. And then we had one more adjustment, and I'll show you that. So the next one, if I can get my pointer off this thing. So here, yeah, here's the next one. So the next one was on the 15th. Now it's trading up to 111.92. So it kept moving up, and we took profit. It was trading. The spread now was blown out to 485. We had adjustment. We're now, you know, before we were on the 14th, we adjusted it to the 107.112. And now that spread, we were into it at 151. Now the spread had blown to 485. And so we were up over $334. for 324% return. So these are the kind of combination of things that you'll get with the alerts, and hopefully that kind of summarizes everything for you. If there are any questions, feel free to ask. Be happy to answer any questions anybody has. All right, so make sure